Thank you for joining us for our quarterly investment strategy titled Inflation's Flame Flickers. As we turn the page to the fourth quarter, things look very similar from a capital market standpoint to 3 months ago. Namely, the S&P is enjoying a double-digit return, but it's led by a narrow handful of technology-based, AI-influenced companies. In terms of inflation, inflation's embers are cooling, and just like 3 months ago, the debate right now is whether the Fed has finished raising rates or whether they have one more hike to go. What's probably most different right now than 3 months ago is that the economic margin for error between growth and a recession is significantly diminished. To that point, here's a chart that we've used a number of times over the past year and a half that talks about the strength of the labor market. What we're showing here in green is the number of job openings versus in gray, the number of people unemployed. And of course, since COVID, there's been a huge dislocation where there's many more job openings than there are people to fill those. In fact, in the peak, which was June of last year, there were 6 million more job openings than there were unemployed people. A huge demand for labor that couldn't be satisfied. That has diminished now to a delta of only 2.5 million. Again, this has been one of the foundations why we thought there would not be a recession this year. Because after all, when the Fed historically raises rates as much as they have, it's caused the economy to slow, layoffs to materialize, unemployment to go up, and spending to decrease. Our thesis was that this huge margin was going to provide essentially the Fed, rather than destroying jobs initially, would destroy the demand for jobs. And that's exactly what's happened. That's provided great economic cushion, but that is greatly diminished now. The second thing that has kept this economy afloat is money. The consumer has been flush with cash. And here, to that point, we've taken a look at what we call excess savings. In other words, we zero-based this going into COVID. What was the level of savings in America on average? And as you can see, month by month, with the COVID relief money, the excess savings grew to over $2 trillion. And over the course of the last year and a half, that's been spent. And what that did is provide a cushion for consumers to absorb the cost of inflation. But as you can see, that margin is all but gone now. So now we're back to the savings level that we had pre-COVID. Now there's some good news here on the next page, because as inflation has come down and wages have gone up, we're now at the point where actually wage growth is growing more than inflation. Wage growth, the most recent reading, was 4.2%, inflation was 3.7%. So what this means is, yes, the consumer has lost the margin in savings, the excess savings is essentially gone. But from this point forward, if wage growth is greater than inflation, they won't have to dip into savings in order to maintain their level of spending. Now, turning the page to the equity markets, we've talked about this obviously all year, that a small handful of stocks, let's call them the Magnificent Seven, Microsoft, Apple, NVIDIA, Google, Tesla, those names to date represent 86% of the total return. The other 493 names have only contributed 13%, with an average return of 2%. So if you didn't have one of those growth names, you were not keeping pace. In fact, this year, it's been the mirror opposite of last year in terms of the index returns. Last year, if you look at the S&P as divided by the Russell 1000 growth versus the Russell 1000 value, you can see on the next page, the growth index in blue, you see was down 30% last year. It's up 25% this year. And the value index is very muted. If you look at the 2-year sort of slice, they're both right now in about the same spot. The growth index is down 12% and the value around 5%. Again, that's the contrast between our core strategy, which would be more like the blue data series, and dividend value in gray. They both have arrived at a very similar destination over the last 2 years, but it traveled a very different path. Now, in terms of what's driven this market year to date, earnings have been flat. So the appreciation has come just through multiple expansion. In other words, people have paid more for a dollar of earnings. Right now, the forward PE on the market is 18.3 times. The average over the last decade multiple for the S&P is 17 times. So the market's not cheap. There's no doubt about it. Essentially, what the market is doing is pricing in a soft landing. In other words, no recession next year and earnings growth. Now on this page, you see a yellow circle that says 2024 earnings per share, 10%. Question mark, and that's really the key. In order to justify the market multiple that we have right now, we're going to have to see some high single-digit earnings growth. And it's not out of the question. Right now, the error of the estimate has been to the positive side as the consumer and the economy has proven to be more resilient than even the most optimistic person thought a year ago. So the key going forward is whether earnings materialize next year. And of course, next year, in our belief, we're finally going to answer the question as to whether we're going to have a hard landing or soft landing. In other words, will there be a recession? We have kind of a tug of war here right now outlined in red, the issues that would point towards a hard landing, right? Tight credit, higher interest rates, commercial real estate stress. On the other hand, offsetting that is a very firm, robust labor market, healthy wage gains, moderating inflation, household net worth at an all-time high. It truly is kind of a tug of war, if you will. Right now, it's our belief that we will have a soft landing. In other words, it's going to be an economic slowdown. It's not going to be a collapse in earnings, but of course, this is something that we're keeping our eyes on. Now, as of the recording of this video, we're 2 days away from a potential government shutdown. We think that will probably happen, but again, we have a lot of history on this. There have been 20 similar occurrences since 1975, and the history is very clear. The impact is very small and temporary in terms of the economy and capital market impacts. The average duration has been 11 days, and the average market movement in both directions is only 4%. So again, this is a media event. This is something that is very temporary and something that is not an asset allocation sort of opportunity. And again, we think there probably will be a shutdown because the fact is the U.S. does not have a revenue problem. We have a spending problem. And the sooner that both parties realize that and make some hard decisions, the better off the capital markets and the economy will be. Now, shifting to asset allocation, with interest rates up, it's been another challenging year for bonds. But right now, the yield on the aggregate index is over 5%, twice the 10-year average that we've seen over the last decade. So bonds are starting to provide not only value, but of course they provide safety should this equity market sell off if we have a hard landing. Now, we haven't made an asset allocation change since we overweighted equities at the bottom in March of 2020. Leaning into risk assets since then has been the right call. But as this economic cycle wanes, and we'll keep an eye on whether we're headed for a hard landing or soft landing next year and whether equity earnings will hold up, the chances are that we will sometime in the coming months make an asset allocation change to take money out of risk assets, go back to more of a neutral position in equities, and lean into bonds. But again, there's a lot of things we're looking at, one of which, of course, is whether the Fed has finished raising rates or not, because we don't want to get in the way of further rate hikes. But again, this is something we're getting ever closer to, making that more defensive, more cautious allocation within balanced accounts. In summary, the labor market is cooling, but it's still pretty darn warm. Equities are priced for a soft landing, and we think that's appropriate at this point in time. We'll know for sure next year whether it's hard landing or soft landing, as next year we'll have felt the full effect of all those rate hikes that have been working their way through the cycle for the past year and a half. Government shutdowns, they're not a capital market event. And the best course of action given this backdrop is both caution and patience. Thank you so much for your time and attention. Be well, and we'll look forward to seeing you in January with our 2024 outlook.